Friday, y'all.
Joining us now, a partner from Element Wealth. That would be Jeremy Nelson. Jeremy, thanks for coming in. Just watching all the red ink today. Fed Chairman Jerome Powell came out and after their Jackson Hole, Wyoming strategy session, an annual event where the Federal Reserve Bank presidents gather up and talk about their plans. And, of course, the focus this year was on the primary tool they have, which is the Fed funds rate. And they came out and said, we're going to be a bit hawkish. What do you think?
Well, I kind of laughed this morning at first. The commentators were kind of saying there was a little bit of something for everyone in there. And I went, what are you talking about? He clearly said, look, that there's going to be potential pain to the economy, that inflation is the number one priority, that they're going to stomp it out. So, yeah, I think what you're seeing right now is the Fed has kind of backed themselves into a corner because they left monetary policy so easy for so long. I was going back and looking at some numbers, the increase in money supply. So not just the low interest rates, the increase in the money supply.
Yeah,
right?
the bond buying.
Yeah. You go back to Milton Friedman, right? And money printing creates inflation, right? It's kind of that simple over the long periods of time. Over the last 3 years, as of January, the money supply had increased by 50%. The last time that the money supply had gotten anywhere close to that was June of 1973.
Jeez.
And, it was up 40% over the 3 years at that point in time. And we kind of all, some of us remember or have studied kind of what happened there in 1974 after that. So the Fed backed themselves into a corner. Inflation got out of control. There was too much money. Interest rates were too low, too long. And these are the consequences. And they're going to have to continue to increase rates further from here, which we've been talking about this for months now, that we kind of saw at least 3.5% by kind of mid-ish next year. Some are now talking 4%. But, I think what spooked the market was not the overall level that the Fed's going to go to. It had kind of got priced in that they would go up and then cut and next year. And now they're saying, hey, we're going to leave rates higher for longer to really stamp out this inflation. And that's what triggered the markets to go down a little bit today.
Yeah, I think there was an expectation of some indication of pivoting. Mm-hmm. Get to a point. We think that's done it. It's done the magic.
Yep.
On the CPI, and once that starts to moderate and trending downward, we're going to back off and start reducing rates. But we didn't get such an indication.
No, not at all. Which I thought was foolish because you just don't ever really see the Fed go up, like going up a mountain and then start coming down. I mean, they're going to kind of hang at that plateau for a while, typically, unless there's an economic event that causes them to go down the mountain. So I think they're going to climb the mountain on rates, and they're going to stay up there for a while to ensure that the inflation comes down. Because ultimately, long term, the inflation is worse than a minor contraction.
Right, exactly. And so I think the Fed still thinks they can thread the needle, though, right? They can avoid a serious downturn, a serious recession, but rather maintain, I don't know, kind of a soft one. Yeah.
So if you go back to 1940, when inflation gets above 5%, it has never once, it's been happened about 9 times, it has never once not ended in a recession.
Right.
So although we've been on the show saying we're not in a recession right now, our concern is a little bit more towards 2023, 2024, where you've got these higher interest rates for a longer period of time. Right now, you still have, really solid job growth.
Yeah.
People are making money. So you're not seeing a big contraction, but if you have these higher interest rates for a longer period of time, then yes, you could get that recession down the road.
Yeah. And then, of course, we're seeing the 10-year up today over 100 basis points. So I think it's 1.2 or something, if I'm not mistaken.
The 10-year Treasury is at 3. a little over 3%.
But the increase.
Oh, the increase, yeah.
So,
but it had spiked up close to 3 earlier this week as well. So there was the bond market was kind of giving you a little bit of a different take.
Yeah. But, of course, that drives mortgage rates, and we've already gotten some rather negative reports from the housing industry, and that is a big industry in this country that drives so much economic activity.
Yeah.
So that's something to be concerned about. In fact, I think year-over-year sales down like 20%.
Yeah. So what we're kind of seeing in the housing market right now is across the nation. So regionally, things are always a little bit different. But across the nation, what you're seeing is, these overbids are not happening anymore. It's turning into a little bit of a buyer's market, but prices have been still holding up. They're not just absolutely cratering. So what you're seeing is that demand and supply are kind of finding equilibrium right now. And over the next 6 months, probably though, supply could start outpacing demand, and you could start to see housing prices come down.
Yeah, and of course, it's somewhat localized too, isn't it? I mean, it always has been. It seems like even more so than ever. Certain markets, even here in Mississippi, I know there are certain markets that are still quite strong. Demand is strong. Prices have really not moderated, and there are other areas of the country where, in fact, demand is down, and homes are sitting on the market a little longer. Inventories are up. Prices are down. Driven, of course, by, I guess, a little bit of a pullback in economic activity, but most importantly, mortgage rates.
Mortgage rates. I mean, we're seeing the 30-year mortgage now at 5.75, which for most of the listeners out there who owned houses in the 70s and 80s and 90s, even myself, my first interest rate was 6 3/4 in 2004, and I thought that was a reasonable rate.
Yeah.
So for our listeners, some of us we laugh, 5.75, that's not that big of a deal. But when you're coming from a real estate market that was predicated on a 3% 30-year mortgage, the purchasing power of a dollar to buy a house has really gone down a lot.
Yeah. And because there are two main factors or inputs into that. The affordability of a home for a home buyer is the rate of interest and the sale price of the house.
Yeah.
So, I mean, that's pretty easy. And so usually those go in opposite directions, of course. Yeah, so all that's figuring in. I think the question that are on a lot of people's that is on a lot of people's minds is, what is the time frame here? I mean, the Fed really didn't give us any indication of that. Just said we're going to keep raising rates till we get this thing under control.
So right now, what I would expect, so we can kind of go into expectations on what the Fed's going to do, and then maybe hey, what do you do with your money?
Okay.
But so right now, the Fed is likely to go 50 basis points in September. I don't think that they're going to go another 75, because I think in July, when you saw the inflation numbers start coming down a little bit, and I think you're going to see inflation come down a little bit more in August. That gives them a little bit of cover to not be totally hawkish and do 75 basis points. So they go 50.
Yeah.
Then they go 25, 25, and then then they'll kind of start to slow it down into next year. Now, how long they have to leave the rates up is the big question. And what they talked about today was being data dependent. So how long they're going to have to leave rates up really is going to depend on whether or not they start to get the inflation back down to their target.
Yeah. Well, which is still 2%. We're a long way away from that.
I'll tell you this. I mean, if I was betting, I see zero chance that they're cutting rates next year.
Okay. Zero chance.
That's you would have to see the economy really start to contract and a complete reversal on inflation. And history just doesn't suggest that that's what will happen.
Yeah, it just flashed on the screen that the 10-year up 1.7 basis points now to 3.04, above 3. So That, of course, is what drives mortgage rates. We got a break. You can hang around?
Absolutely.
Let's see what else we can dig up, because there's a lot of news, economic and financial news today. Stay with us. Jeremy Nelson, partner at Element Wealth in the Element Wealth studios. Jeremy Nelson, partner at Element Wealth. So for the average person out there, Jeremy, they're worried about their 401ks. They see a day like today. They don't want to even open it up. They don't want to see where it is, right? The market now down, the Dow, 645. And they have witnessed extreme volatility this year. Mm-hmm. Would you agree?
Oh, absolutely. Absolutely.
It's crazy. Rhino says it's kangaroo hopping around what the market looks like, and I agree with him. So those that are considering retiring, and they've been plowing money away in their various savings instruments, 401ks, whatever the pensions, whatever the case may be, other investments, and they're trying to figure out, can I jump now? Do I have enough? That's a big issue for all of us, is it not? That I know you guys run into is, hey, do I have enough in my nest egg here to sustain me for my remaining years and live kind of the lifestyle I want?
Absolutely. So every person that comes into our office, that's the question, right? How much is enough, or do I have enough? So number one, you got to have a plan. You got to understand how much it's going to cost you to live. Let's just say then we've determined that, okay, you do have enough assets and income sources to retire. Then it comes down within the plan to creating, a blend of income growth guarantees, right? So you've got a stable, sound retirement. But when we start thinking about distributing assets, one of the things that we're doing right now, because there's a lot of uncertainty, the one thing that I can honestly say right now is that we just don't know exactly what everything looks like going forward, because look, we've never been through anything like we've been through. We've never seen a 50% increase in the money supply. We don't know how long inflation is going to last.
Right.
What I do believe is over time, our growth assets like stocks will be okay, because inflation ultimately gets passed through. Corporations are going to make numbers over time, but it could be bumpy in the middle of the road.
Yeah.
So what we're suggesting to people is saying, hey, look, let's look at what we're going to spend for the next 3 years. And let's ladder that out into defined maturity things, bonds, either, high-grade corporate or treasuries or municipals, where we know that on January 1, the money that we're going to spend is going to mature, right? It's going to be there for us. So we're never being forced to actually sell any of our growth assets like stocks while they're down. So that, to me, is the smart thing. The other thing you got to look at is kind of what's the overall risk profile that I'm sitting on here? Is it appropriate? Can I handle the ups and downs that are coming or that we've been dealing with? Because it's likely that it could continue for another year, two, even more potentially. So look and see how much money you're going to spend for the next few years. Kind of reserve that into a bit of a bond ladder. So now you've got a 3-year runway on those stocks. So when they're going up and down and you're seeing a 600-point down day today, it's not affecting you because those assets are carved off for a little bit of a longer time period.
Yeah. And so I guess the flip side of the decline in equities, which is being largely driven by macroeconomic conditions, which of course includes the Fed funds rate, interest rates in general, is fixed income securities are doing better, right?
Well, that's it. You can finally make money on bonds.
Yeah.
So, right now the sweet spot on the yield curve is around 2 years. So the 2-year is sitting around 3.41% this morning.
Yep.
The 10-year Treasury is severely inverted, just above 3%. So the sweet spot on the yield curve is, the 2-year. Now, the mistake that people make, and if you go back to the 1980s, this is what everyone did. Remember, CD rates went through the roof. And everyone said, well, why would I buy a 10-year Treasury bond at 12% when I can get 18% on my CD? Well, those 18% CD rates didn't last, did they? They came down. So now you lost it. when you could have locked in 12 or 13% on a 10-year Treasury for a long period of time. We're not. I do not believe we're at a point where you want to be locking in rates. I think that 10-year is going to end up going higher over the next year or so. I don't think it's going to go up at the same rate. But so I look at, if someone is kind of on the fence, looking around that 2-year maturity is a pretty good spot to be, because then it's going to give you the opportunity to kind of lock in the higher rates once we get there. I'm pretty convinced that the inflation is going to come down. I'm actually very confident in that. So I think as we get into 2020, later 23, 24, there's going to be opportunity to really extend the durations of your bond portfolios, own some longer-term things. If we do get into an economic situation, then interest rates will go down, those bonds will go up in value, and they will create a little bit of ballast in your portfolio to offset some of the stock market volatility.
Interesting. So if your feeling is we're going to see the 10-year continue to tick upward, I mean, that's going to also drive mortgage rates up, because it's tied to that.
Yeah, mortgage rates, in my opinion, are not done. Now, do I think the majority of the damage is done? Yes.
Okay.
Right. I mean, I'm not saying we're going to go to 10% mortgage rates or anything like that. But could we go to 6.5 from 5.75 today? Absolutely.
Interesting. Well, that we'll see what kind of impact that would have. But a lot of folks out there, they're nervous about this. Especially now, if you're younger and you've got time,
don't even worry.
Right. But if you're at that point where you're looking at that account and you've seen a significant decline over the last year and a half, you're worried, right?
Oh, I mean, you have to be, and that again, that's where you've got to have a plan. Like, we've had callers who have called in and come and met with us, where we're sitting down and we're saying, look, let's do an inventory. Let's take the emotion out of this. Yeah. Let's really come up with a plan. And let's figure out, if this happens, this is what we're going to do. It's kind of like a football coach goes into a game. They've got a game plan, but they also know if things happen in the game, they're going to adjust the game plan. And they've already got that laid out. Good coaches do, right?
Sure.
And a financial plan should have the same thing.
Yeah, it makes sense. I mean, because you have to be nimble.
Yeah.
Because you can't tell from one day to the next. I mean, you do your best with the data and the input you have today, understanding that you may have to adjust as the data changes.
Yeah. Look,
it's just simple as that.
When you do a financial plan, the only thing that you know is that things are going to change.
That's true.
Right? That you don't have all the future information to make all the decisions. So with the information you have today, you make the best decisions possible. But putting your head in the sand and doing nothing is not the best option.
All right. So a couple other things to hit on is got to be concerned with taxes. One of the ways to avoid federal income taxes is to invest in municipal bonds. How are they looking these days? I mean, it wasn't too long ago. It was like a 1% investment. It's the most you could get.
Yeah. So
maybe.
So muni rates have moved up now. Municipal rates. So let's use kind of AAA state, government obligations. So kind of the safest of the safe.
Yeah.
They're not going to pay quite as much as treasuries or corporates.
Right.
Because they're tax free.
Right.
So what you really have to look at here is, if you're in a lower tax bracket, then munis don't make sense. You'd rather pay the taxes and get the higher interest rate. It's a simple
on a taxable investment.
Yeah.
Right.
So it's a simple calculus where you go, the tax I'm going to pay on the interest is X, the yield is Y, that nets me this. Is that better than a muni?
Yeah, makes sense.
Yeah.
All right, so the other thing that it's 3 years out, but the Tax Cuts and Jobs Act enacted under President Trump in 2017, the individual tax provisions are scheduled to expire at the end of 25.
Yes. So within our financial planning software, we have everything run. So as we're projecting future taxes and things like that, what we know is they're set to expire. And so what we have in our financial planning system basically is that there's a sunset of the provisions, the taxes do go up, and we're factoring that into financial plans right now.
Well, I'm hoping that it continue at least level. I'd like to see even more cuts, but it would be devastating, I think, to the economy if we let those things expire.
Absolutely. I think that for the average American, the tax cuts have been a good thing, and maybe the government should just figure out how to spend a little bit less.
Unbelievable. What a novel idea. Jeremy Nelson, partner at Element Wealth, thanks for coming in. Appreciate it. Yep. We will step aside for a break right now on middays. The market, the Dow down 646. ZZ Top bumping us out of this segment. Half an hour left. We'll be right